Hello, everyone, and welcome back to Your Finance TV for your Friday musings with Jay Poloski. What a great time it is to be sitting down with Jay Poloski after a week like this. How are you, Jay?
Good, Scott. How about yourself? Did you dodge some raindrops this morning?
We actually had a very big storm run through here, so lost a little bit of power, lost a little bit of internet. But all in one piece, all good. But you still did manage to send through your musings for us, which I'm very excited about. But what I don't really get here, that you've titled them "When Facts Rock Fiction." Run me through that title.
Well, it's from a song, so it's another one of my lyrics, and this is one I've had in the back pocket for quite a while, and really been waiting to use it. And the full line is, "When facts rock fiction, always cause friction." Okay.
Okay.
So, do you want to take a shot at the song or the band or even the genre? This is
Listen,
a
my family knows that I'm terrible with lyrics and I make up the wrong lyrics for different songs, so I've got no idea.
okay, no idea. Oh, you're not alone. I was on Bloomberg this morning, that other channel, and asked John Farrow if he knew, because it's a from a British band, and John's British. I mean, you're Australian, so somewhat related. And he had no idea either. So you're not alone. Anyway, Steel Pulse is the band, reggae is the genre, and the song is Blasphemy. So,
Not
yeah,
ringing a
shake
bell.
your head. I mean, I admit it, I mean, it may not look like it today, but back in the day, and this was from 1979. I mean, so, 40 plus years ago, gives you a sense of how old I am. Back in the day, this was Steel Pulse was one of my go-to bands. So anyway, when facts rock fiction, always cause friction, and the friction has been the kind of epic cross-asset moves that we've seen this week. So let me just run you through a couple to give you an example, and our viewers an example of what we've seen. The dollar. Okay, DXY had a 52-week low, broke back under 100, its worst week in 3 years. So this is the worst week in 3 years for the US dollar. And it was right on time, because last week we talked about, in digestion time, we talked about the yen trade, right? People short the yen. And we talked about how it was like picking up pennies in front of steamrollers, right? So these guys, that's exactly what happened this week. The yen rallied almost 5% in 1 week, 5% against the dollar. So those guys got steamrolled, right? And then you had the bond market, 40 or 50 basis point moves in a week for the 2-year and the 10-year. And it's amazing, because there's one factor that ties the two of those together, and it's the fact that the smart money was record short both of those instruments, record short the yen and record short the 10-year. Here is Bespoke, which are some pretty good research people. Large speculators are net short 780,000 contracts on the 10-year note future, the largest short position ever. So the important point is that we've had these cross-asset moves, and it's been mostly short covering. Okay, so the real money has not yet even gotten involved. And so that allows us to continue to, believe that we want to buy the effing dip, should we get one. We talked about digestion time last week, and that digestion was pretty quick, because this week has been, as we know, has been a rocket. So here, let me just finish on the smart money with a quote from Goldman Sachs on the equity front. Our prime brokerage data shows that hedge funds have the lowest weighting to the US stock market since our records began back in 2013. So the smart money went into this week record short US equities, or shortest in 10 years, record short the yen, record short treasuries. And what's happened? Yen up 5%, treasuries have rallied massively, and the equities have had a considerable move. So not a good week for the smart money.
Yeah, we could actually even refer to that as like the herd trade, right? It's me being an ex-Merrill Lynch person, being known as a thundering herd back then in the day. It seems like the herd trade has happened, and it's obviously bitten them.
Yeah, no, it's people. I mean, I'm just amazed that positioning is just so aggressive at this point in time, right? I mean, the yen at 145 and you're record short. Treasuries, the 10-year, the 2-year at over 5, and your record short. The 10-year at 4, and your record short. Yeah, it just doesn't make a lot of sense. Thankfully, none of those positions are what we've been advocating, and none of those positions, record short positions, are what we have deployed in our 2 model portfolios here at TPW Advisory. It's actually been one of the best 6-week periods from the beginning of June through the middle of July that we've had in years and years in our models. So thankfully, not
Like
there.
you said, like there's some epic cross asset moves there which you're going into, but obviously we had inflation data out this week. What was your main takeaway from that?
Well, those were the facts, right? The facts were the very strong data, right? Whether it was jobs data, moderating jobs, but still solid job growth, CPI data. We've been talking about it for ages. It was no secret, right? You had a huge number in June of 2022, 1.2% inflation in June of 22. We knew that number was going to drop out. Why it was a huge surprise to people is just beyond me, but super good inflation number, very good PPI number, very good earnings, right? So if CPI is at 4 and PPI is 0, then the potential for companies to generate decent earnings is there because their costs, PPI, the inputs, are falling faster than their output prices, what they're actually selling. So actually, it sets up for a pretty decent earnings picture. So our main takeaway, though, the main thing that we walk away from is that the big risk, which is Fed over tightening and crashing the economy, has been removed, right? And so that puts into play one of our key investment mantras, which is the Fed on hold equals a weak dollar, which equals better opportunities in non-US equities and commodities. So that's, and the market is migrating just along those very same lines, right? We wrote a piece almost 2 months ago exactly, in May of, I think it was May 19th, so not quite 2 months, but Friday, May 19th, it was titled Rotation. And we talked about rotating from big tech to US cyclicals. And over the last month, just to give you a little bit of data, went a little bit too far. Over the last month, the CPI is SPY, the S&P, up about 4%. The Qs are up 5%. Remember the Magnificent Seven and all, it's just a few tech stocks. Well, guess what? Transports, IYT, up 10. Home builders, XHB, up 10 over the last month. So 10% move. So that first rotation from big tech to cyclicals is well underway. In this past week, we've had the second leg of that rotation, which is from US to rest of the world and from digital to physical, okay? And so again, just let me give you some numbers because I think they're so powerful. Over the last 5 days through up till yesterday's close, S&P up 2, Qs up 3, EFA up 6, emerging markets up 6, copper miners up 11, and KWEB, China Tech, up 14. So we have had some rocking moves in just the last week. And I think what it does for us is it sets us up because we're moving out of a very favorable period for US equities into seasonally, what's called seasonality, a less favorable period. The mid-July to mid-October period is kind of the least favorable for U.S. equities. So the way we're thinking is we want to take some profits in that U.S. tech and rotate that into China tech, and into commodities, like we just said about copper miners being up 11% in the last 5 days. So you may not want to buy them just today, but you want to be on the lookout for any pullback, because again, those big moves we've seen is pure short cover. We really haven't seen yet the real money coming into commodities, coming really into emerging markets. And if the Fed is on hold, then we're moving from rate hikes to rate cuts led by the emerging markets. The dollar weakening, breaking under 100, supportive of non-US equities and commodities.
Okay, so that's good for, like, air quote, the short term. What are you thinking on the medium term, like over the next few years then?
Yeah, well, I think that's exactly the right way to think about it, because again, we've touched on it on the last couple of issues here on Your Finance TV, but we're in July. People are going on vacation, right? When people come back from vacation, we start to focus on the out year, on 2024. In the way we're thinking about things, 2024, 25, 26, we're quite constructive. Right, we talked about it in not our last monthly, but 2 monthlies ago, titled "The Birth of the New." Right, new industrial policy, new high nominal growth world as central banks get more comfortable with inflation between 2% and 3%. Not going to jam the economy to get to 2% inflation, and then the new innovation cycle coming from AI, which should really be supportive for productivity. One of the things that I think is going to surprise people is how rapidly AI integrates into kind of the broad society and the broad economy, and how quickly that can be manifested into productivity gains and continued sustained high margin activity for companies. So that brings to mind our analog, which we have been talking about since last year, right? The analog for us is the second half of the 1990s, which is the last time the US had a CapEx boom and a productivity surge. The productivity coming from the internet, the productivity the next couple of years coming from AI. The CapEx boom we expect to see now is coming from that new industrial policy, right? Bidenomics, and it's happening all around the world, because every region, our tripolar world, the three main regions in Europe, Asia, and the Americas, everyone's realigning supply chains. Everyone's trying to deal with climate. Everyone's trying to figure out how to make sure their tech stack is their own and is secure. So all that suggests to us that there's a really decent environment of economic activity for the next couple of years. And that's really where we want to play. And I'll leave you with this, Scott. LPL, so not our work, but another good firm, LPL's work, they agree with us on the 1995 analog, in fact. And they said, and their work suggests that if you model out the second half of 1995 and equate that to the second half of 2023, the upside for the S&P could be as high as 5,000. So we've talked about how we think there's an opportunity for a new all-time high to come later on this year, right? So that's another, now it's only like 5% away, so not a big lift, especially if 2024 is a better year for growth, especially if earnings are going to pick up, double-digit earnings growth forecast for 2024. So the analog to 1995 is that you could have a double-digit second half of the year. So that's not necessarily our view. We do think higher. We do see potential new all-time high, but we think the real opportunity, again, just to finish, right now, the real opportunity is in emerging markets, particularly China. China, the government is making peace with the big internet companies. That's why K-Web had its big pop. They're supporting the housing sector. There's going to be new policy support coming later on this month. very cheap at 10 times earnings, almost universally hated. So that's the play we think in EM right now, China. And then on the commodity side, very constructive on industrial metals like copper, as well as on the energy sector. Just to finish up, Brent at the end of Q2, that was 4 down quarters in a row for Brent crude oil. The last time it hit 4 down quarters was in 1988. So we like oil, we like energy here. The idea of being a second half global economic recovery, early cycle, not late, Fed done, dollar down, commodities up.
Great breakdown, Jay, and it's all short and sweet and to the point for people this week. I love it. Absolutely love it. Now I'm going to have to go look up that tune. I'll have to go afterwards, just find out what it is and get a little bit.
Make sure you play it loud, my friend.
I will get a little bit of reggae going this weekend.
Yeah.
On that note, Jay, have a great weekend. We'll be talking to you again next week.
Exactly. Take care, Scott.
And for everyone else out there, good luck investing.